Well, the world looks quite different from the last time my next guest joined us here on In the Loop last year. Last November, in fact, global hedge fund investor and trader Michael Novogratz manages $4 billion at Fortress Investment Group, and that job got tougher after a lot of events. The earthquake in Japan, the protests in the Middle East, our budget gridlock here in the U.S. You just heard Senator Jeff Sessions talk about that. Mike, great to have you stop by again.
Thank you very much.
And, of course, John joining us as well. And I'm serious when I say this, Mike. When you hear about the budget gridlock and you see that there's so much debate going on in Washington on this, is it good or bad for the markets?
If you take the budget gridlock right now at face value, this is a little bit much ado about nothing. It's a bit of a kabuki theater. Are we going to end up at $32 billion or $34 billion or $35 billion? And will the government get shut down for a day or not get shut down or get shut down for a week even? In the long run, that doesn't really matter in the big scheme of things, right? We're $1 trillion plus a budget. And so, but I think it's important to presage what's going to happen, for the next 18 months, really through the election. We're going to have a series of these flashpoints, the debt ceiling next. You'll have another CR, another budget gridlock, probably in the fall on the 2012 budget. Then you might even have another debt ceiling, depending how big how high they raise it.
Right.
And so that's going to set up for this political debate, which really will all play in the 2012 election. And nothing substantially will get done on deficit reduction until 2013.
So in the meantime, does that mean that the equity markets just keep rallying then?
I think so. I think that this doesn't have a big impact. Where it could have an impact is as you look forward, one way or the other, this is going to end up in more fiscal conservativeness, more fiscal discipline. I think it's known by both sides of the aisle that these big budget deficits can't last forever. And so there is a big chance of a fiscal drag, starting second half of this year, or maybe first quarter of next year, when, if you think about macroeconomics, GDP equals C plus I plus G, G is going down, not up, depending on how fast that goes down and how much consumption and investment in the rest of the economy picks up. We'll see if it really slows the economy enough.
Mike, what's it like trading? What's it been like trading over the last few months? I mean, between Japan, Europe, we're talking about today, and even not knowing where things are going here.
Because you look really nice and relaxed.
Well, thank you. Listen, it's a terrible way to say it, but the exogenous events are at times the tragedies, and they make trading interesting. So you're in this two-edged game. You're feeling some empathy and sympathy for the victims or all of these tragedies, and your adrenaline's juiced because it's changing the world and making quick decisions. I think the base case scenario this year that we had started with was that the economy was growing and was going to start picking up momentum, and we've seen that in the last two jobs reports, and that the Fed was going to stay easy. I think the chairman wants to orchestrate some inflation. That was the point of QE2, and I think he's going to continue with that. And so being long risk assets seemed to be and continues to be, I thought, a pretty obvious way to look at the world. And, when you get hit with exogenous events, you got to quickly decide how lasting, how important. And listen, they are important. The Mideast much more so than Japan,
right,
in a lot of ways.
But Mike, last time you were on, though, you were somewhat betting on a deflationary trade here. I think you had said something like that you'd buy. If Treasury sold off, you'd buy.
Right. The great part about being macro is we can change our mind quick. What has surprised me a little bit, and literally I think you've seen a big shift, even in the last month, is the inflationary pressure showing up.
Yeah.
You had Li and Feng out in Hong Kong say the 20-year era of deflation coming from China is over, and they're seeing price pressures. You had the president of Walmart last week, which I think was very key, saying we're seeing price pressures from all our suppliers all over.
So that's off for you then?
Yeah, I think we are now, if you look at oil prices, food prices, and inflation in the developing world, we are certainly seeing inflation pressures.
Do you short the euro? Are you short the euro?
I'm not short the euro. I don't have a position in the euro.
Okay.
But I think, listen, the ECB is, no matter what they said, I think they've embarked on a series of rate hikes. It's pretty well priced into the market. They will most likely go 4 total and get the rate back to 2% from 1%. I don't think this is about the economy and inflation. I think this is about the ECB regaining some central bank independence and kind of fighting back from this giant incursion on their turf.
It's about debts and deficits, right? That's what it's about.
It's about them being forced to bail out the banking system and wanting to say, okay, we're going to push back a little bit.
Mike, what sort of message does it send investors that Trichet is moving now when the Fed doesn't seem to be moving on higher interest rates anytime soon?
I think that's why the euro has rallied. You've got two central banks with two different philosophies. I think the chairman is pretty headstrong on creating inflation. It's one way to get us out of some of the debt trap we're in, and he still is worried that the economy could take could slow down with the fiscal drag that we're going to see, starting late this year, next year, and really wants to see the economy grow strong for a while before they raise rates. And so,
Mike, if the ECB does more rate hikes, what does it mean for oil? I'm thinking back to 2008 when crude was as high as it was, and the ECB thinking then, what happens now?
Well, the difference between now and 2008 is in 2008 we were in a commodity bubble. It had all the mania of a bubble. People were talking, my God, it'll go to 250, it'll go to... Now we've got crude higher because global GDP has come back, strong around the world, and so you've got growth. You've also gotten supply shocks, with what's gone on in the Mideast, with what's gone on in Japan, with refining capacity in Asia, and so that's putting some pressure on. I think it's the pace. If oil continues to creep up, at one point we'll hit demand destruction, and it'll slow the economy down. But I don't think we're going to see the collapse that we did in oil.
At what point would that be, you think?
It's the
in your outlook?
$64,000 question. Yeah. I was going to ask you that question.
I don't run $4 billion.
we're probably getting close. I mean, if you look at the price of crude in Japan, it's already almost $130.
Right.
I don't know if it's $150 or $160, but
But are you a buyer or a seller of oil right now?
You're a buyer of oil. There are pressures that are pushing the oil price higher.
Are you a buyer of the dollar?
I have been buyer of the dollar versus some currencies and a seller versus some, and I think we're seeing real dispersion this year for the first time. Broadly, the dollar's been for sale because the core of the Fed has said we're going to keep rates low for a long time.
It's been surprising, though, right? Because we've had the jobs growth, but the dollar's been weakening amid that.
Because people see the Fed as very, very easy.
What about the Japanese yen? You lived in Asia. Do you fight the central bank intervention?
Listen, this is another great question. For the last 4 years, every foreigner has been wanting to short the yen and has been paying at the altar and losing money, and now we're finally starting to see it move. We're optimistic that the dollar can rally versus the yen, hoping and thinking that this will galvanize some political force in Japan. Right. That said, last night the BOJ kind of disappointed. We're seeing more liquidity than QE.
All right. Didn't you say something, Mike, before? I think it was a couple of years ago, where the easy money, the money to make, the easy money is already sort of off the bone. It's a lot harder for banks now to make money, right?
Well, listen, after 2008, when asset prices got eviscerated, 2009, once you had decided you put in a bottom, there were wonderful credit spreads and very, very cheap equity valuations.
Right.
Now it took courage to go in. Credit spreads have gotten to very tight levels, and equity valuations, while still cheap, are a lot more fair than they were. And so, now you're betting more on the economy and where things are going than the multiple.
The Fed. Yeah, exactly. But the question about volume, I mean, what's going on there, Mike?
Why are volumes down?
Yeah.
If you look at the history of kind of post-crashes, you usually have big drops in price, a couple years of recovery, and if you look at the Nikkei post its crash, volumes peter off, right? People leave the casino.
Right.
And so retail volumes, after the flash crash last year, went down. They've been slowly coming back up, but not near to the level they were even before the flash crash. So the mom and pops kind of walked away from the market.
What's going to drive it up again?
Confidence. Confidence as the economy comes back. Listen, the last two jobs report and the claims report I'm hearing through your headset today are showing that the economy's picking up jobs.
Right.
And if it can continue, you get a couple more months of jobs reports picking up, and confidence starts to come back, you'll see that feed through the markets.
Sara?
wanted to ask Mike about what is going to be driving, what keeps him up at night, basically. You've got the Middle East, you've got China, you've got Europe now raising rates. We have stubbornly high unemployment in this country. What is it that you're trading on of all of those things?
Listen, I think the most important driver of markets is going to be inflation. And, you know, you have the Chinese government asking Unilever to not raise prices, and they're trying multiple efforts to keep inflation down. Through reserve requirements, raising rates, price controls. They have an inflation problem. The rest of the emerging markets see perky inflation, and we're starting to see it. And so
it's inflation.
It's inflation.
Mike, thank you.